that kind of led me into Hex in a very sort of unusual way, because most people, they find out, that somebody tells them about Richard and they see Richard and then that leads them to Hex. But I started with Hex and that led me to Richard.
That's great. That's great. Yeah, and thank you for whoever did that marketing. I mean, clearly it worked to onboard some folks such as yourself. I'm sure you're not the only one. That's an interesting case study, actually. I'd like to dig into that if you're comfortable with it. Could you tell us, can you walk us through the tax implications for that situation? You made the Ethereum that was in China. You converted that to Hex. It sounds like you made some stakes. Can you just walk us through, if you don't mind talking about it, the intricacies of the tax implications for all those steps?
Yeah, sure. So one thing for the UK, we up until February this year, we actually had minimal guidance from HMRC, and it was only we only kind of had some outline guidance. And when I was originally advising clients, so this would have been 2018 when their taxes became due, there was nothing. There was literally no guidance from HMRC on crypto tax at all. And I gave my advice to the clients, and it turned out HMRC published guidance about a year down the line, and it tied in with what I told them. So I was really quite happy at that point in time. But from a UK point of view, things have chopped and changed quite a bit, and there's still quite a bit of uncertainty in terms of how HMRC want to treat things. But in practice, what you've got is capital events, and most of the transactions with any crypto are going to be capital. They're going to be buys and sells. But with the advent of DeFi, that introduced mining. Mining was always there. DeFi introduced staking, and it introduced kind of weird and wonderful different projects, which made things a bit wider. In the olden days, it was you had mining, and mining is an income. So you mine crypto and you technically earn it as it is provided to you. Now, obviously, you should value it at the value you receive it. And if you're receiving it every few seconds, then it's practically not possible to value it each and every few seconds every time you finish a block. But from a practical point of view, you've got a rough idea if you look at it on a monthly basis, and that's simple income. It's subject to income tax. It's miscellaneous income from a UK point of view. And one of the nice things about miscellaneous income is if you're doing a little bit of it, there's £1,000 allowance. But actually, if you're working on it on a bigger scale, like I was, it can actually become a trade. So what you then have is if you're starting up a trade of crypto mining, you have got to buy all the equipment, and the equipment you get allowances for your capital expenditure, and you can offset that against your income. So I had a period where for the first sort of couple of years we were just kind of covering our costs, and then obviously over time it kind of built up. But it can either be trading income if you're doing it kind of a bit more professionally, or if you're kind of just randomly mining on your graphics card at home, it's probably going to be miscellaneous income. It does mean you're going to pay tax on it if it's more than that £1,000 limit. So for somebody who's working, it might be they're going to pay 20% tax on it. It might be they'll pay 40% tax on it. The highest rate in the UK is 45%. But what you then do is you attribute whatever value you attributed to it when you treated it as income tax. That's your base cost for capital gains tax thereafter. So kind of I
just want to say in this scenario, what if someone else was mining for you, right? That was happening, but then you were the recipient of it in your wallet, right?
Yeah. So it depends on why you received it. So is somebody mining on your behalf? In which case, that you've either got a gift, or if and I'm just trying to think of a sensible way of setting this up. If for argument's sake, I gave you my computer to set up, and you set up the computer, and the computer sat in your living room, but effectively it's my asset that's generating the income for me, then it's mine. So it is a question. If I was mining it and then giving it to you, that's a gift. And that's a disposal for CGT purposes, so you'd have to be aware of that. But if you're kind of giving it on an ongoing basis, the miner pays their tax on it, and if they're giving it relatively quickly afterwards, then there's unlikely to be much of a gain because the value shouldn't shift significantly in that period.
Is there a difference between signing up for cloud mining and what happened in your situation where you weren't really aware, but then it ended up happening? Is there a distinction?
Not really. At the end of the day, I mean, back in the day, I mean, when you used to buy kind of mining contracts, I don't know whether these are still a thing. But effectively, what you've got is a capital outlay on the upfront part of it. You've then got trading income. So your argument in that situation is, will your capital outlay cover the income cost? But it is in theory, what you've got is, unless, let's think about this in practice, with a mining contract, you're buying a right to use it, so that's effectively a lease of the machine for a period of time, so that would be deductible against your income. So yeah, I mean, you're going to have to look at the specifics of the transaction, but I would imagine in most cases what you're doing is you're leasing out that equipment for a period of time. So let's say you spend $1,000 on a mining contract, you've leased that hash rate for that period of time. If you then make $1,500 from that mining contract, you've got a $500 profit, but that's going to be income because it's a mining income.
Okay, and then the conversion between Ethereum and Hex.
So that's a straightforward CGT disposal, so capital gains tax. So what you would look at in that situation is, what was your acquisition cost of your Ethereum? So in my case, it was the value of the Ethereum as I earned it, the amount that I declared for income tax purposes. So, and that's in most of these cases, what I say to clients is anybody who's doing anything more than just buying and selling a bit of simple crypto, you need some software to deal with these things. So you need a piece of software that will recognize and record what the price of your Ethereum or whatever you're mining was at the point in time when you receive it. So for example, at the moment, I've got some DOT staked, I've got some Ethereum 2 staked, got some other bits and pieces staked outside of the kind of Hex ecosystem. But because that feeds directly into my software, and I think software is probably something we can talk a bit about later, at the point at which it lands in my wallet, the software picks up the value of it and attributes that to it. So if I were to then sell it, I've got a base cost attributed to it. Now, doing that manually is a tough process over a period of time, unless you're really focused and you're sitting there, on a daily basis doing the numbers, and nobody wants to be doing that. Buy some software. It's a lot easier. It's a lot cheaper.
A lot of work,
yeah. But yeah, so effectively you've got a base cost for your Ethereum, you have disposed of that, and you've got probably a gain on your Ethereum, potentially a loss, who knows what. Okay.
And then Hex staking. So Hex staking in the UK, let's go through that part.
Yeah, so Hex staking. So when I first started advising people on Hex, we treated it as ordinary staking. So basically we said, staking is an income source. We're going to treat that as income tax, and consequently we will just tax people at their marginal income rate on whatever Hex stakes they receive. However, in February they released some new guidance, and actually I'd been talking to a couple of people in the Hex world about the actual mechanisms of how the Hex contract works. And the HMRC guidance basically looks at the concepts when you stake coins, and they were really looking at the mainstream kind of centralized exchanges. They were looking at the likes of BlockFi and Celsius. Sorry, if anybody who's hurt by that word. They were looking at the big centralized exchanges as their kind of primary source. And what they basically said was, if you have a situation where you deposit your funds at BlockFi, for argument's sake, or Nexo, or wherever it may be, and they can do something with your tokens, you've disposed of them. So, the likes of Nexo and BlockFi, they make their money by taking you stake your Ethereum. They make their money by taking your Ethereum and sticking it somewhere else they can get a better yield. When it might be lending it out internally, it might be kind of sticking it into other projects, but they take control of your assets.
Just a quick question. So dispose, is that the same as abandonment?
Sell. Let's say sell.
Sell. Okay.
So dispose in UK tax, dispose is a sort of a general term that covers everything from losing, gifting, selling, and they within UK tax they all have the same effect. So if I've got some hex that's worth $1,000 now that I bought for $100 and I lose it, I'm treated as having a gain of $900. If I give it to you, I'm treated as having a gain of $900. If I sell it to you, I'm treated as having a gain of $900. There are reliefs in certain situations. So if it's lost, then there are certain reliefs that can give you CGT reliefs. If
it's lost, could you claim it as a loss? Sorry, I'm using like the I guess the US tax words and stuff, kind of intermingling. Correct me on the UK terms though, but is that the kind of relief you're talking about?
Yeah, exactly. So if it's lost, and you have a loss. However, weirdly enough, HMRC, if it's stolen, HMRC take the view that if your crypto is stolen, you still have you have the legal ownership of it. You have the primary legal right over that. So it's not a disposal. So if somebody comes in and hacks and steals all your funds, you haven't disposed of it. So there's no CGT event, which means you can't have a loss on it, but you haven't triggered any gains.
You triggered me on that one. You triggered me on that one.
Don't worry, it triggers a lot of people.
I mean, when you lose crypto, it's not like, if you lose your car, you may be able to recover your car. You lose your crypto, that's a different process that usually doesn't happen. And
I've not had to put in a claim for theft on crypto yet, but there is we have something called a negligible value claim, where you can put in a claim where something has gone to nothing. So for argument's sake, let's say you invest in some random shitcoin and you put $1,000 into a shitcoin, and it turns out to be a rug pull, and there's no liquidity left, and you're left holding this bag of shitcoins that you can't sell because there's no liquidity, there's no way of actually getting rid of the bloody things, because you can't sell it, you can't crystallize that loss. So
you could send it to the PulseChain and PulseX sacrifices and hope Richard has mercy on you. I think that's the only thing I can see on that one.
Yeah, but what you can do is you can make this thing called a negligible value claim that basically says that if something has become of negligible value, we'll pretend you sold it, and because it's worth nothing, you've sold it for nothing. So your base cost was 1,000. It's now you've sold it for nothing, and you get 1,000 loss to offset against your other gains. So there are ways around it. But sorry, we've kind of get distracted by the word disposal, haven't we? So well, we were talking about so if you put it into a centralized exchange, that's a disposal, and that was a big issue for a lot of crypto investors, because if you are in a position where you've made some good money on your Bitcoin or your Ethereum or whatever it may be, and you want to stick it into a boring sort of centralized exchange and get a little 4% yield or whatever it may be, or whatever they're offering, 10-12% sometimes, to be told then that that's a taxable event and all of those gains that you've built up to date are now triggered, was a significant shock for a lot of people. And I had a lot of sympathy for those people, but then when you sit down and you think about the legality of it, you have given those coins away. You are no longer in control of those coins. And I think taking it to court.
Which situation are you talking about?
On a centralized exchange. So let's say you've got BlockFi, you've put your tokens into BlockFi, and BlockFi have now loaned them out to somebody else, because that's what they do. You have lost control of those tokens, and HMRC's view is that you've sold them, and what you've actually got is a right to receive some of those tokens back in the future. And it is, it's a bit of a scary thought for a lot of clients who thought they were just sort of stashing things away for a rainy day.
Does it even make sense to do it then? Like, how can you even win doing that?
Well, I mean, the advantage.
Is it regulated out? you know?
Yeah, and a lot of people took the view that they put it in there, and they would borrow against it, and they'd use that as collateral forevermore, and borrow some USDC or USDT or whatever it may be that they cash out, and that's their spending money. But suddenly, the fact that they've actually crystallized again, I've just seen the comments.
Comments are getting spicy. We're only halfway through. Don't worry.
I told you, tax is it's a divisive subject. But and coming back to the point, the reason why that's relevant is because actually you then look at the hex contract, and what happens when you stake hex? Well, the hex no longer exists. It gets burnt by the contract, and you are effectively given T-shares, whatever T-shares are. They're a right to receive a future amount of hex depending on your conduct during the period you're staked. Mm-hmm. So you have disposed of your hex at that point for some T-shares. But what that also means is on the other side, your earnings, your income from your hex is not income. What it is you've acquired your T-shares, and at the point where you end your stake, and you now transfer your T-shares into newly minted hex, you've sold your T-shares and you've gained your hex, and you've got a capital disposal. Now, where that becomes interesting is that if you have a big long stake, which is now 5 years down the line or whatever it may be, or if you're one of the very early people where your interest is significantly larger than your principal. If you were in early and you've now got a stake that ended and has got £100,000 or $100,000, whatever it may be, of interest, then normally that would be taxable at income tax rates, probably 40-45%. Now, because it's a capital event, it's taxable at 20%. So it's halved your tax bill.
And that doesn't matter because I'm thinking short term, long term. Just the fact that the stake ends and you're trading the shares in for the interest and the principal that was originally put in. That's taxed at a lower tax bracket, the 20%. So what you said?
Yep.
Very interesting. Okay, well, so, it's kind of like you're getting hit with a big club and they give you a Band-Aid, I guess, but it's not as bad as it sounds at first.
Yeah, exactly. And there is this balance where in the right circumstances, if you are kind of having a regular period of kind of staking and ending and restaking and ending, what you tend to get is kind of an averaging out of your tax exposure. Whereas if you're in a situation where actually there's no disposal and all you've got is a bit of income and a bit of income and a bit of income, and at the end of the day you then sell your principal, you've got a huge gain. So, to some extent, certainly at the lower levels, if you can use tax allowances and things, the process of crystallizing a bit of your gain each time a stake ends and restarts is not quite as bad as it could be. It kind of smooths the curve as you go along. But there are a lot of people who are still not very happy with the concept of crystallizing CGT when you start a stake. Because you could quite easily have a situation, particularly if you've been liquid for a while, where you've held that hex, it's hopefully gone up in value. You've then staked and locked up your capital for a significant period of time and triggered a tax bill at the same time. So that can be a nasty situation. But it's about knowing the tax consequences of transactions before you have them, particularly if you're talking about big numbers.
Yeah, and how about if folks are doing ladder stakes? You have stakes ending every quarter, every 6 months, every year for 2, 3, 5 years out. What are the intricacies around that?
It's the same. There are individual stakes with hex and T-shares, and each one of them will trigger a gain depending on the growth in value of your crypto in the meantime, or loss as it may be.
And maybe I wasn't clear on is there such thing as short term, long term? Before a year,
no.
After.
So in the UK, for capital gains tax purposes, it doesn't matter how long you've held it for. We and you don't worry, you can talk about US concepts. I do a reasonable amount of international tax.
I'm just trying to wrap my head around like the different words and the different styles.
So we don't have a concept of long-term and short-term gains. We used to have reliefs that said that if you'd held an asset, sort of a non-business asset for more than 3 years, your tax rate reduced proportionally. So over time, the actual tax rate, if you held something for 3 years, you'd pay more tax than if you held it for 5 years, and you'd pay a higher rate of tax than if you held it for 8 years. That was all wiped out quite some time ago, and we now have a flat rate of 10% on the first £50,000 of income and gains. So if you have no income at all, your first £50,000 worth of gains are at 10%. We also have a £12,500 tax allowance. If you earn £30,000, you effectively have your first 20 at 10% and everything else at the higher rate. And higher rate is 20%, which in the grand scheme of things, actually internationally is pretty good. And every year us tax advisors are concerned that they are going to look to kind of equalize capital rates and income rates, but it's not happened yet. But the UK is much like most other countries. We're a bit low on money at the moment.
Yeah, I bet.